In trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion. And welcome back, Market Rebels. Happy Thursday, everyone. And Stu,
hey,
finally, a little bit of a bounce. I think we were up about maybe 0.5% or so on.
Yeah, a little bit of a bounce. It's a peak at the day, and not
more
too
in the
bad.
Qs, I think 0.75%.
Yeah, a little under 1%. But we started out lower and closed a little higher, and it's kind of an uptrending all day thing.
Yeah, so we'll have to see what happens for the rest of the week, or one more day, and then next week I think will be even more interesting. But hopefully we've hit a little short-term bottom. But I thought what might be a really cool topic, they're actually all cool topics, we think, because they're all on options, but especially for times like this, we see the market starting to fall. People get very risk-averse, and they all want to hedge their positions.
Hedge, keyword there.
Because they all say, I know that's what options were designed to do. So they think that no matter what they do, they are hedging their positions.
You know what I love? I love this. Somebody's got a beta-weighted portfolio delta of, I'll make a number up, 3,000. But I got 10 put spreads.
Yeah.
Really?
Okay. You got the Rolls Royce, and you've insured the hubcaps,
The Jetta. Yeah.
You get what I'm saying. You get the rear view mirror. It's not doing anything. But we find that a lot of people just misinterpret the entire definition of a hedge versus speculation. So that's what we're going to talk about today. We're going to show you a very kind of a simple way to think about if you are hedging or if you're leaning more towards speculation. So let's take a look. And as always, we're going to start off with a little chalk talk question. This is our little thought question, which we will answer at the end. So here's the setup. You own 100 shares of stock, and you see that the market's starting to pull back, and you say, not only do I want to hedge it, but I want to doubly hedge it. I'm going to go out and I'm going to buy 2 of these put options, 2 at the monies.
Mm-hmm. So
the question is, did you hedge the shares of stock? It's kind of up for debate. It depends, but we're going to show you the way that we think that most professional traders would interpret this. All right, so we want you to think about your answer, jot it down, and that way it's going to make you commit to an answer, and then we'll come back at the end and answer it. So today's topic, as you've probably guessed, what is a hedge? So if you understand the definitions of hedging versus speculation, that's going to go a long way into helping you figure out if you really and truly are hedging, or maybe actually doing the reverse and the opposite. You're actually speculating, even though you think you're hedging.
Or maybe you're doing both.
And maybe you're doing both. But this is why a lot of times traders get into trouble and step into these traps, because they say, I'm learning options. I know that they are designed to hedge, and I'm hedging. And they're really not. They're speculating. So it's kind of a fine line here, and that's what we want to talk about. So let's start with the definition of a hedge.
Whenever we talk about hedging, what we mean is that you are giving up some potential gains. In exchange, you are sharply reducing the potential losses. That's really kind of classic.
And it's also like, are you giving up some potential gains? Oh, you know what? Actually, the answer to that is yes. Yeah, I was going to say maybe, but yeah, you are definitely giving up some potential gains.
Yes. Oh,
maybe not the gains, but the potential.
Correct. But at least potential.
Yeah.
Now, if you have a small reduction in losses, yes, it could still fit with the definition of a hedge, but we would say it's a slight hedge or a small hedge.
Yeah.
If you're really trying to go for a big hedge because you think the markets are going to come unglued, you probably don't want to be doing small hedges. So hedges are simply just trade-offs in risk and reward. Again, as we always say, there's no right, there's no wrong. It's just a different choice. It's a different place to perch on the risk-reward continuum.
Yeah. What are you looking to ensure?
What are you trying to do? What are your goals? So another thing to understand is all hedges are partial. All right. You cannot hedge all losses. There is no such thing as a 100% hedge. And that's because at a minimum, you must pay for the options. So if you have 100 shares of stock and you buy a put for 5 and it's an at the money option, traders say, oh, I'm 100% hedged. Well, yeah, but what about the $5 you spent on the put? That never comes back to you. So there's always a cost. So at a minimum, you've got to pay for that. So this is another thing to understand. There really is no such thing as a 100% hedge. And any open position, no matter what it is, has risk.
And just to clarify here, so the open word is key here.
Yep.
There are strategies you can go in and you can convert. All right, you could buy the put, sell the call on the same line, same strike, same expiration, and you could create what could be termed 100% hedge. It's just a bond. That's it. You just have an obligation at some place, in the same place you have the right to buy, or the right to sell, I should say, on the put side. But then it's not really a hedge anymore. It's just a synthetic sale.
It's a synthetic sale, right? If you own 100 shares of Microsoft, you shouldn't sell those 100 shares and say, "Well, I did it as a hedge."
You're just getting out. You're just getting it. So it's not really a hedge anymore. For what we're talking about here, hedging is you leave something to be gained, and you take away something that can be lost, and you are creating a hedge.
Very good. Yep. And so if we have an open position, we're just trying to shift these risk-reward profiles. So another question is, what should you hedge? Well, there's lots of things we could hedge, and this is by no means a full list. But first and foremost, risks that you don't want to accept. Another one that I think traders overlook is if you have trades with multiple risks. We were just talking about this afternoon, Stu, with Vega risk.
Yeah.
Something a lot of traders overlook. Well, you might have Vega risk. You could have gamma risk. You could have all kind of delta. You could have a big delta risk.
Yeah, you may not even know it. You could have a delta that you did know, which kind of flipped on you, and now you don't even know you have the opposite side of it. So the point here is that if you're looking to hedge risks that you don't want, that kind of means that you have to recognize what risks are present and will be present down the road in order to create a plan to hedge off something that's there or that is not there now that might be there later.
Might appear. Yep. Also, positions where the risk has grown outside of acceptable limits.
Big.
We talk about this all the time in Q&A with our example of the guy that goes to Vegas and bets a $5 chip and runs it up to 5 or 6 million, and then loses it all and gets back to the hotel room and tells his wife he lost $5 because that was the amount of the chip.
Yeah, that doesn't really work.
Traders do this all the time. They watch this position get bigger and bigger, and then they say, "Oh, but I've only got $2 into it or $4." Yeah, but the thing's trading for 27 now.
Yeah, or they rely on something, which is really an accounting term. I mean, there's lots of ways to interpret it, but you could say, "Oh, well, my cost basis, an Apple is 15, and now it's trading. Where's it trading now? 170 or somewhere around there." So, and if you did that, you'd say, that's like kind of saying, well, if it goes from 170 to 15, it's okay. Well, is it really okay? No, it's not okay.
Right. You're not going to.
You can't rely on that cushion that is a cost basis. It's about where you are now, and you got to move forward.
Right. So in order to answer all of these, what do we need? This is why we always go back. You got to have goals. And if you have well-defined goals, these become easy. You'll know which risks are the ones that you want to take and which ones are the ones you don't. And when to hedge, roll, all that kind of stuff, it becomes very easy. So
yeah, all the answers become apparent.
Oh, they'll be right. Exactly. Be red hot. You won't have any questions at all. But these are, and again, it's not a full list, but these are some of the things to think about before you even go out to hedge. If you're perfectly willing to hold the downside risk, let's say in Microsoft, there's no reason to go out and buy puts on it.
Right.
Okay. That's a risk that you want to accept in that.
But you have to assume, if you're going to make that statement, you have to be able to not assume, but you have to be able to say, I'm willing to accept 100% of the downside risk, no matter what, no matter where it goes, I'm willing to accept it.
Yeah. And if that's true, then don't try to hedge it, because that's something that you were willing to accept.
Yeah.
Right,
go buy the stock and have a good time.
So that's the background for the hedging. Now, what about the kind of the counterpart to this, which is speculating? Now, speculating is when you are putting money at risk in pursuit of profits. So we are intentionally increasing the risk of a position or of the entire portfolio, but we're doing it in anticipation of gaining profits.
Which isn't a bad thing.
It's not a bad thing.
It's not a bad thing at all. It's, speculating, when I first saw this, I thought to myself, it kind of has like a dirty ring to it. Oh, you're speculating. It's not that way at all. I mean, we're allowed to speculate. We do it all the time. You just have to do it within reason, and you have to know that you're doing it.
Right. Everything involves some degree of speculation. And really, I shouldn't just make them as like two different sides of the same coin. The better way to see it of hedging and speculating is that they're just different points on this risk return kind of continuum. You could buy shares of Microsoft, going back to that example, because you think it's going to go up over the next 5 years. That's still an element of speculation.
A degree.
It's
it's still a degree.
You don't know for sure, but you are willing to put money into it in exchange for greater profits.
Look, there are those that could even say, if I buy a T-bill, I'm speculating. I don't personally agree with that, but that person that says that agrees or says that there's some element of a default on the T-bill, then they're speculating. But if you do term it risk-free, then you're no longer speculating, and that's really the basis, isn't it, Bill? Isn't that the whole basis between
speculating that interest rates aren't going to spike?
Yeah,
there's a lot of
you'd say that as well. Mm-hmm.
Yeah. So the main thing that we want you to get from this is that, for the most part, if you are putting money into a position because you're trying to capture more money, that's going to fit into our definition, at least for this presentation, with speculating. So again, you're increasing the potential for profits, but you're also increasing the potential for loss. That will be important in a little bit. All right. Increasing
more risk, more reward, more
risk, more
loss, more, everybody's heard that. More risk, more reward.
So those are kind of the definitions we're going to be working with. So we're going to go take a look at that. And before we do, for anybody who's new, please join us at marketrebellion.com/get started. Lots of great videos, classes, absolutely free, that can help you get started to become better options traders, because it really comes down to not predicting the market, but understanding the mechanics of options. That's going to make you proficient. So
yeah, I can't predict the market. Can you predict the market, Bill?
Never have been able to.
Bill, what's going up tomorrow? Do you know?
I have no idea.
Me neither.
It might not even be up. So exactly what we do is the analogy we always use is it's about playing the cards that you've been dealt. That's different, like a poker player. What makes somebody a professional poker player is knowing how to play the cards they've been dealt, not in predicting which cards you'll be dealt. Okay, so anyway, good little stopping point for you right there. So let's get started with some examples we thought would be a good way to show you the differences between hedging and speculating. And to do that, we want to show you a very simple question that you can ask that will help you to kind of make these determinations. And what's that question, Stu?
Oh, isn't that my old girlfriend? Why are you talking to her?
Kind of does look like a name.
My ex-wife.
What's the one question you have to ask? All right, something changed.
Yeah, what changed?
And we have to say, what is it that changed? And if you do that, then it should be pretty clear if you are hedging or speculating. So instead of trying to memorize all kinds of definitions and stuff, just simply ask what changed. So let's run through some examples. Think about what changed. Go back to those definitions and then see if you think that it's a hedging or speculating. So let's start with the first one. We're going to do 5 different examples here, 5 different light bulbs. First one, we're going to buy shares of stock, or maybe we already own them, and we're going to buy a put.
Mm-hmm. Are we assuming in this example for every 100 shares we're buying 1 put?
Yes, we are. We got 100 shares of stock. We're going to buy 1 put.
All right, and the 1 put, of course, is delivering 100 shares.
For
that's why it's 1 to 1. Yep.
So we want you to think about it. Not long, 5-10 seconds. Do you think this is a hedge, or is it speculation? And here's the way that we would figure it out. Here's a risk graph for our long shares of stock. Here's our stock prices along the bottom. The vertical shows the various profits or losses. So the first thing to notice with shares of stock, we can make dollar for dollar up. We can lose dollar for dollar down. We have this unlimited downside risk. That's the big risk. And one of the tenets that we always talk about in financial risk management is to avoid extremes. You shouldn't bet everything on the flip of a coin where you can either double your money or go to zero. That's an extreme outcome, but that's kind of what you're doing with shares of stock. So if we buy the put, we're going to transfer our risk graph. We're going to kind of morph it into a different creature here from the black curve to the blue. All right, so what changed here? Well, the first thing I see is that we need the stock to go up, in this case, by 5 points. We're assuming we paid $5 for the put. But we need the stock price to rise just to break even.
Right. You have to pay for the insurance, $5. So where's it going to come? It's going to come from the movement of the stock.
Yep. So this little zero line, that horizontal line, shows us 0 profits and 0 losses. So that's a break-even point. So back when we had the shares of stock, you can see that we were breaking even back here at 100.
Exactly where we bought them.
Yep. But when we bought the put, we pushed that forward. So the first thing to notice of what's changed is we have a small reduction in gains, not complete reduction.
Yeah, which is part of the definition of a hedge. Yep.
So we've given up. Here's another way to see it: is that the blue line, our new one, sits below the old one.
Yep, it make as much.
If we knew the stock was going up, we would have gone onto the blue line. We were making more on the black line. So we're giving up some of the upside.
Wait, hold on. Did Gordon Gekko know the stock was going up?
No. We talked about that one last week.
Well, why did he buy the calls? Sorry.
Exactly. Or not sell the puts. But what else do we notice? We still retain almost all of the upside. We have 100% of the gains just minus the $5 or whatever we paid for the option. So we've got a reduction, not an elimination. We got a reduction of the gains. But why did we do this? Why would we reduce our gains and push our break-even points forward?
It sounds like a bad idea, doesn't it?
It does until we look at this end.
Look at you eliminate
a massive amount of this downside risk. So
and that could be painful. That could be painful.
Some people have no idea. So think about this with our basic definitions of a hedge. You've given up some of the gains, right? Think about what changed. We've reduced our gains, not eliminated them, in exchange for a reduction, and in fact, in this case, a fairly good-sized reduction in losses. So what is that?
And no, there's no formula for how much of how much. It doesn't really work like that.
Right. We just want you to understand the basic definitions. So what do we think about this one? Long stock plus long puts do.
I'm going to say that's a hedge.
We would agree that's a hedge. All right. So you didn't buy the put to speculate that prices were falling. You did it to block off a good chunk of that risk.
You did it to ensure your cash.
To ensure the downside, the bulk of the risk, the main part of that risk. So this is kind of a classic hedge. This is really what options were designed to do. So that one gets the green light.
Which, by the way, everyone, is a synthetic call.
Call option. Very good. Yep, we could have just bought the call. Let's do another one. Now, here's where a lot of traders think that they're doing themselves a favor.
Yeah.
We see this a lot where people will have, let's say, 100 shares of stock, and they go, oh, but I want to really doubly insure. I want to doubly hedge my stock. So I'm going to go buy 2 puts. All right, so we want you to think about that for a moment. Think about what changed, if you can sketch these out in your head.
Yeah, think about the graph and think about what happens
about
down the
what
road.
you're
And,
doing.
my friend Rob and Dr. Joe, look, you guys know the answer to this. Pair
Oh,
them
yeah.
together, right? We just kind of gave you the answer the last time. Look at the stock, look at the put. If that's a synthetic call, you have a synthetic call. What do you have left over?
Lots of ways we could pair that.
And what's that going to look like?
Mhm.
Go ahead.
So let's go take a look. Here's our long 100 shares of stock. Again, dollar for dollar up and down. We don't like that. If we buy 1 put for 5, this is what we just saw. There's our bend at the 100 strike. Max loss is now at 5 over here. That's the cost of the put. So again, back to this idea of 100% hedge. Even though we have shares at 100 and we have insured them for 100, it doesn't mean we have no losses. Here we've got a $5 loss. You got to pay for that.
You got to pay for it, just like you pay for your car insurance, your homeowner's insurance. They might rebuild your house after the hurricane, blow it down.
Doesn't mean it was free.
But you had to pay for the insurance to get it.
You never get that back. So now what happens to our risk graph if we buy a second put? We're going to move from the blue to the red.
Right, because you had to pay a little bit more, right? You actually had to pay double because 5 and 5 is 10.
Yep, we've increased the potential losses. Very good. That's the first thing to notice. What else do we have? Look at over here. We can actually make money to the downside. So we've increased the potential gains. So what do y'all think about that?
Doesn't look like it's fallen into the hedge category.
Absolutely not. Yep, we've increased the potential gains in exchange for increasing the potential losses. That is absolutely speculation.
Yeah.
It is not doubly hedging. You're not doing yourself a favor. It is speculation. And again, this is why a lot of traders can get hurt.
So
think back to GameStop when it was at 600% volatility and they got shares of stock and they go, oh, let me go buy 2 puts so I can really insure it. Super bad idea.
Yeah, that was a real bad idea. That really didn't work out. So, there's something about this. You could get down to the nitty gritty of it. You could really say, well, I did insure the 100 shares, but then what about the other put? That part is speculation. So is it pure hedging? No. Is some of it hedging? You could argue that point that it is, but you can't ignore the other part as well.
Correct.
Just have to be honest with yourself and say, I did hedge the 100 shares, but I'm also speculating at the same time.
Right. And I
think
that's
it's going to cost me money to do that. So, and that's going to come out of, it's got to come from somewhere, right? They're not going to write you a check for nothing. I mean, someone's got to pay for it. So it pays for it out of your potential gains.
Yep. So that's the main thing, is to look at what changed. We've increased the potential losses. We used to be able to lose down to the blue at 5. Now it's down to 10.
Mm-hmm.
But with the blue, we had no chance of making money on the downside. We could avoid losses or reduce them. But with the second put, we can actually make money.
Yeah.
We've put more money, we've exposed it to more risk in exchange for more reward. So it's just kind of interesting that we bought 2 puts, something that we think of as insurance and conservative, and we've doubled up on it. But that doesn't necessarily mean it's doubling up on your insurance. This flipped it right over on its head to speculation.
Yeah, made it speculation. Yep. Mm-hmm.
Absolutely.
Interesting. Real interesting.
So what do we think?
So that would be a big fat no.
Red light or green light? Stu's giving it the red light. I'm going to give it.
No, that's a thumbs down.
Yeah, I give it thumbs down too. What about the next light bulb here? What do we want to check out?
Long stock and short put. So you probably want to take me off the screen for this because this really annoys me. Go ahead.
It's we hear this a lot, and it's one of the reasons that I included it. And I have a feeling you know where I'm going with it too. But
yeah, and we hear it a lot because of the flow of the money.
Yep.
See, the flow of the money is what takes people to the wrong place, because the short put is a dare I say credit, is bringing in money.
Gosh.
People think it's that money is going to protect me. Well, maybe a little bit to the tune of how much you brought in, but what about after that? What can happen? So go ahead.
So this is where we have to, again, go back to our risk graphs. This is what we're trying to show you here. So here's our long shares of stock that we've seen. What changed if we go to stock plus a short put. Well, we moved from the black. Oh, so what happened here?
No,
Notice
kinda
that if the stock goes up, we used to profit up to the black, but with our new position, stock plus a short put, we can actually increase the potential gains.
by the amount of the dollars that we're bringing in.
Right. And this is where people say, oh, but I've lowered my break even. That's true, but you lowered the break even because of the cash you brought in, because of the additional risk that you accepted.
That's right. You didn't get it for free. You took additional risk.
You took additional risk. So you've actually doubled your risk. You had 100 deltas here or 100 shares. And now after selling that put to the downside, you've got potentially 200 deltas.
And how's that going to feel when the stock's going down, Bill?
It's going to feel twice as bad, Stu.
It's not going to be pretty.
Nope. So what's happened here is to always remember, too, that option sellers have obligations. They are accepting risks. And so this is another thing that would make you realize that once you look at the risk graphs here, you have the additional potential for gains, but you're also accepting more risk. And this is why you have to be super careful about saying it's purely a hedge because I've brought in cash. Well, again, it is true that you've reduced your downside a little, but that's trying to put the cash, into a different column here. You're looking at this credit that was really because of the accepted risk. And then you're saying, okay, by the way, it's reduced my break even. Well, no kidding, but it's because of the increased risk.
I think that's one of the biggest problems of this educational process with options, that people just tend to not think about what the obligation really represents.
Yeah.
Right. Everybody reads the chapter that says option buyers can be rights and option sellers can be obligations, but that's where it stops. Right. People don't really think about what that obligation could really entail. If you have an obligation to buy stock at 300, because you sold the 300 put and the stock goes to 200, you're going to be in a world of pain. That's $100. And maybe you got $8 for the put because you think it was a non-probable event. You thought it was real juicy and the vol was 70 instead of 40, and now what are you going to do? You're out $92.
Yep. Exactly right. So you have to always be aware and say, what changed? And so it's nice little technique that can help you to at least understand what the trade-offs really are.
Mm-hmm.
All right. So what do we think about this one? Long stock and long and short.
Double down.
Double. I would too. Yeah. I don't like that. And the main thing that I don't like is that it's really accepting additional risk in exchange for additional profits. But people see those additional profits as a way to reduce the break even. Yeah, but that's also because you're accepting more risk.
Now, I will say, as a trader, which I've been for many, many years, like over 40 years now, as a trader, I will say that there are times when I am willing to accept that additional downside risk, given 100%. The amount of money that I'm being paid. I've earned the right to make that decision.
Of course.
And I can make that decision. And if I accept that obligation, then I'm an acceptor of that obligation. Can I hedge that obligation? Sure. Yes, the answer to that as well. And that would be nothing more than a vertical spread. See, I can buy the right to sell the stock lower than where I'm accepting the obligation to buy it. Correct. And I'll get paid a fee for that. And there's nothing wrong with that. Nothing wrong with that at all.
Where it becomes a problem is like Stu is saying, somebody might look at, let's say, again, a $300 stock because the options start to get pumped up there, not just because of volatility, but just because of the cost of the underlying. And so traders will look at this and say, I've got 300 shares. Wow, 3 puts are going to really cost me a lot of money. Well, if I sell them, I can also hedge. Well, again, you got to be careful. You're really accepting much, much bigger downsides. And it's that cash that's reducing your break even, but you have to be super careful. I would say this by itself, for the most part, not a good hedge.
Not if your goal is to
hedge.
Hedge.
Right.
Exactly. You're adding tremendous obligation.
Exactly right.
Yeah.
Okay, so let's try the next one. And before we do, a little reminder, in case you didn't catch it the first time, marketrebellion.com/get started. Lots of great videos and
let's get started.
Information to help you to, as it says right there, to get started. So let's move on to light bulb number 4. What's another bright idea that we have here, Stu? We've got long stock and a short call.
Otherwise known as the covered call, buy
Yep.
right, whatever it is you want to call it, long stock, short call. Think of that risk graph. Think of what you get from the stock. Think of what you get from the call.
Yep. So let's go take a look at it. Here's our long shares of stock that we've seen in every slide so far. When we sell the 100 call, we change from the black curve to the blue. There's our bend. We've sold the, let's say in this case, we've sold the 100.
It's our obligation to sell stock or to deliver, as we say, stock at 100 in return for the fee. That's our sale price.
Our maximum gain is 5. So we're assuming that we sold this for 5. And I know that because we own stock at 100, we have the obligation to sell at 100. That's where the bend is. So we've sold this option for 5. We have no potential capital gains. We have reduced our break even by 5 points to this, in this case, from 100 to 95.
And when Bill says there's no potential for capital gains, he's talking about the stock because our obligation is at the same price that we own.
It is at the same price.
We can make a short-term capital gain or ordinary gain, I guess I should say, from, well, I guess that would be a short-term capital gain. From the sale of the options, you can do that, but not from the stock.
Yeah, it's always going to be a short-term one. But anyway, how did we get this credit here? Did we accept more risk? Well, if we look at it, what we've done is we've given up a bunch of the upside. We've still maintained most of, but not all of the downside, because notice that we used to be on the black line. So let's say if the stock is down here at 90, we could lose this much, looks like $10. But if we're on the blue line, we can lose 5. So we've reduced the amount of losses.
Yeah, that fits.
We've given up or reduced. We haven't given up all profits. We've reduced the profits.
Yeah, that fits.
Reduce the downside a little bit. But the thing that you have to be careful of with the covered call is that what you're doing when you're receiving this cash is you are accepting cash today and giving up the uncertainty of the future gains. What you're really doing is to sell off the uncertain gains. So again, it's not for free.
No, it's not for free. You get there is a potential opportunity cost for that. You got to think about like down the road. You always think about down the road. What's going to be the future value of the stock? I don't know. Nobody knows, right? Nobody knows. But if it's 110, in this example, you gave up some opportunity or you gave up participatory rights. You gave up the idea that you can now participate all the way up. Right? You just can't do it. You have a stock, you have an obligation. Where's the strike price here, Bill? 100?
100.
You have an obligation at 100. So you're going to own it or you're going to buy it at 100. You're going to have an obligation at 100. You're going to get paid 5. So your effective sale is really 105.
105.
When you're kind of done with all the math, and it went to 110. You missed out on $5, right? Doesn't make you a bad guy. It just makes you a guy that missed out on $5. And that's okay. If your goal is to, protect some of the downside in return
and you're
giving up these additional $5, which you don't know is there until after the fact, then that's fine. There's nothing wrong with that. As long as you're willing to accept the left half of that curve there, all the way down.
Yeah. Now here's the part where, and I know you and I both agree with this too, where you have to be really careful with the covered call. Let's again go back to, especially with a more expensive stock, just to make the point. You've got a $300 stock and somebody says, you know what, I don't want to sell the shares. So let me sell the 340 call for 10 cents. And they go, oh, I've hedged it because I did a covered call. Well, you've taken 10 cents off of a $300 stock.
Yeah.
We call that zero, Stu. It's close enough to zero. You haven't done anything, but you did seal off the upside. So there, just because you might have read that a covered call is a hedge, that's what we call just a dumb idea.
And look, that discussion takes place anywhere you want it to take place. You can have a $170 IWM, and you sell a strike. I don't know, a week or two out. That's $4 or $5 up. Maybe you get a bone for it, right? Is it a hedge? I don't know. Technically, is it a hedge? $1, but it's to what degree? See, how much of a hedge is it really?
Yeah. And
is it enough for you in the event that the stock goes the wrong way?
Based on your goals. So now if you had, let's say, a $300 stock and you sell the 290 call, it's 10 points in the money, but there's also $8 of extrinsic value into it. Well, yeah, now that's really giving you a pretty good size downside hedge.
Yeah,
and it's giving you
$18
some-
on 300.
And you might say, all right, that would fit more in line with a hedge.
Yeah, 6%.
You got to just be careful about the covered call. Just because you're doing a covered call does not give you the automatic green light to say that you are hedged.
Yeah,
So
just keep in mind
one,
that keep in mind that the hedge that you put on runs out.
Oh, sure.
Right?
Quick,
it runs out.
Quite quick, and can be quite quickly. Yep.
It runs out of money. And then what? You're stuck
big
holding
hedge.
the left side of that tail. So it's, downside tail. It's a problem. Long stock, short call, is that a hedge? Yeah.
Yeah,
To
it
some
can go
degree.
either way. I gave what I did for this one. I gave it a question mark, which I think is what you were alluding to with by hesitating on it. It depends.
It's a weak hedge. How's that?
It could be a strong hedge.
It could be.
but you're also going to have relatively little profits on it. So you have to just be careful with the covered call. I think my main point here is don't assume that you're hedged just because you did a covered call.
Yeah, just don't say, "Oh yeah, I sold the call and I'm hedged." That's not the way it works.
20 points out for a nickel and therefore I'm hedged. No, you're not.
Yeah.
Okay, so everybody catching on. Let's try one last one here. Let's see what this one is.
Long call and short call.
Short call. What is that? We're going to assume it's the same expiration, which is
Vertical.
Which would be a vertical spread. Let's take a look at that. Remember, ask what changed.
Which everybody, look, it's just a name. Don't get hung up on a name. It's the right to buy at a level, and it's an obligation to sell at a different level. That's it.
So here we've got the $100 call. I can see that because here's our bend. Now this time I made the option relatively expensive, at least in terms of dollars. And we're looking at this going, yeah, it's hedged down to the downside, but it's still got a pretty good ways to fall. Or maybe it's just a very high implied volatility, and I don't want to spend $15 on this call for whatever reason.
But
so I look at the 105.
Hold on. What? This is the 100. This is the 100 shares of stock. I kind of lost you here. This is 100 shares of stock.
Call. No, 100 call.
Oh, the 100 call. Okay, got it. Yeah.
Because the question was long call, short call.
Oh, long call, short call. Got it. Sorry. Okay.
So here's our long call. Here's our short call. And let's say it's trading for 12.
Uh-huh.
Now, you might think, hey, wait a minute, short call has got some risk to it. Well, by itself, it does. But notice that everywhere above here, these cancel.
Yeah.
Because you have delta 1 over here. You got delta negative 1 over here. So now you will have positive deltas through here. But once you hit this strike, we should go flat. If I'm reading that right, Stu, it's kind of what it looks like, right? So what's going to happen if we buy this and buy the black and sell the blue?
Well, looks like it's going to be a flat line to me.
We did flatten out at 105. We do have the 100 deltas between the strikes. So what do we notice here? Well, the first thing that should really jump out is we have greatly reduced the risk, the downside. What else do we see? We've given up some of the gains. We used to be able to make unlimited gains with that long call. Now I've limited. It's not that I can't make any gains. I've just reduced them.
I think this is starting to fit into the hedge category, if I'm not mistaken.
That's a very classic hedge. Yep. So buy call, sell call. I think you've already given us your answer. I gave that one a green light as well. Yep. So we hope that would we wanted to run that by you because it's a question we get a lot in our Q&A sessions that people are either asking what is a hedge or they'll say, hey, I've hedged this position. We look at each other going, I don't know if that's quite really a hedge. Certainly not a very good one. And this is, again, where people can get themselves in trouble and why it's so important.
Yeah, and that's key. That's really key. Is it a hedge? Yeah, it might be a hedge, but, is it really doing you any good?
And is it in line with your goals?
Yeah.
So to close up with here, Stu, you own 100 shares of stock. You buy 2 puts. So what do you all think out there? What did you put? Did you hedge your shares of stock? We did this one presentation.
I'll say, how about this? Like, yeah, you hedged your shares of stock, but you're also speculating. So you didn't really do what you wanted to do.
You didn't
really hedge your position.
You've increased the amount for potential losses and you've increased the amount for gains. That's leaning far more towards speculation than saying, I've just really insured my shares of stock. So you can see how easy it is to fall into traps. We hope that helps you. And we thank you for being here. It's always a huge help. And we thank you for all of your support. We hope that you're gaining a lot from it. And so we've got another really cool one that we've already decided on for next Thursday, 4 p.m. So we hope to see you there. And with that, any closing comments, Stu?
No, what you got to have your goals. Make your goals known, make them heard, and then you can answer the questions, all these questions that Bill and I put forth all the time, right? Once you know your goals, if your goal is to ensure in this example, if your goal is to ensure your stock, and another way to say that is cash, because it really is cash, right? All you got to do is hit the send button, and all of a sudden it's cash. So it really is just representing cash. If you're really looking to just ensure the cash, then ensure the cash.
Yeah.
And don't bet to the downside. If you're looking to ensure the cash and to bet to the downside, then go ahead and buy 2 puts. And of course, that's going to be your synthetic straddle. But again, look, it's just a name, and it just comes down to what it is that you're trying to do, which is going to be which makes it imperative in order to evaluate what the risk is and what you can make and what you can lose. You got to have a goal in mind. What are you willing to do with it? How much are you willing to risk? How much are you willing to make? What can you do? And what is your goal? And you can't, what do you say, Bill? How do you put that? You can't evaluate risk without knowing what your goals are.
Right. You can't even define risk without.
You can't define risk without knowing what the goal is. Yep. So,
so as we always tell people, know your goals and know your risk. And we'll see you next week.
Yeah. See ya.